valuation on PolyOne Corporation's common stock. PolyOne, we are issuing in our initiating report a hold recommendation on the PolyOne Corporation's common stock. This is based on our projected 2021 target price of $30. This represents a negative 8.54% downside from the February 15th close of $32.79. We came to this conclusion using a 75%, 25% weighted average of the market multiples and DCF valuation methodologies. In 2000, PolyOne was formed by the merger of Geon and M.A. Hanna corporations. It operates in the polymer industry, formerly a producer of commodity-grade polymer products, now in the process of converting to a specialty-grade polymer producer. The potential success of this strategy is yet to be seen. PolyOne is separated into 4 segments: color, additives and inks, specialty engineered materials, performance products and solutions, and PolyOne distribution. CAI and SEM are PolyOne's 2 most profitable segments by operating margin. CAI is PolyOne's largest segment by overall. PPS is PolyOne's, it can be separated into 4 segments, 4 subsegments, each dedicated to a different specialty polymer. It is also the least profitable of the specialty segments, likely due to its nature of being a hybrid commodity specialty segment. PolyOne Distribution is PolyOne's distribution arm. It's responsible for the distribution of commodity-grade resins to molders who manufacture end-market products. In 2017, PolyOne divested its Design Structures and Solutions segment. It cited the company cited its unprofitability and operating outside of core competencies as its reason for divestiture.
PolyOne operates in the specialty polymer industry. It is a very mature industry with a fragmented market, meaning there are no competitors that make up any more than 5% of the market share. After analyzing the Porter's 5 forces model, the 2 most important forces is rivalry within the industry and bargaining power of suppliers. When looking at bargaining power of suppliers, the price of raw materials is extremely important in determining the gross profit polymer manufacturers are able to generate. This is because the price of raw materials, mainly petroleum, make up the vast majority of variable costs. Also, supply is extremely critical in meeting demand. Therefore, there should never be a shortage of supply or labor. And then on top of that, vertical integration should be implemented, as this will help mitigate risk of high cost and low supply of raw materials. When looking at rivalry within the industry, as I mentioned, it is high. However, to compete and mitigate risk, companies should consider offering after-sales services as well as investing capital in their more profitable segments. On top of that, PolyOne is converting from a commodity to a specialty. By doing so, this should give them more market share as well as give them more market share. And then on top of that, diversification is a key success in the industry. This should mitigate risk of this should give them more of a product base and geographic.
In our financial analysis, we adjusted for the non-reoccurring loss of the DSS segment back in 2017. When looking at PolyOne's profitability, we can see that their margins have been compressed back to 2016. We believe that the return on invested capital has increased slightly since 2016. This is troublesome due to the fact that there is favorable raw material prices in their industry they're operating in. Looking at the relationship between PolyOne's return on equity and the return on assets tells an interesting story. PolyOne's return on equity is 4.5 times that of the return on assets, indicating that they have a high equity multiplier and that they are a highly levered company. When looking further into PolyOne's debt, we can see that their debt ratios have been increasing since 2016. PolyOne has stated a goal of having a debt-to-EBITDA ratio of around 3. Due to their debt ratios have been increasing since 2016, we believe that they're going to continue to increase in the future. And we think that their goal of reaching a 3 to debt-to-EBITDA ratio is most unlikely. Simultaneously, their coverage ratio has been declining while their debt is increasing. This gives us more reason for concern. When looking at PolyOne's liquidity, we can see that it has been strong going back to 2016, but we do have concerns about it in the future and project that it will decrease due to the large amount of debt that they have coming due in 2022.
So in terms of cash flows, we believe that PolyOne will be investing most of its cash flows back into itself to help grow their business. We expect their M&A budget to increase year over year due to the fact that bolt-on M&A acquisitions are critical to their growth strategy, and we also expect their capital expenditures to increase due to the fact that they will be growing their business. We expect their high dividend growth to slow in the coming years due to the fact that they'll be having to reinvest in themselves, and we also expect their share repurchases to stay similar to what they've been in the past due to PolyOne's consistency with their share repurchases doing what they said they would do in the past. We expect their free cash flow to lower in the recent years due to the fact that they'll be facing a high increase in working capital due to the expansion that they'll be facing and the transformation they'll be making from a commodity producer to a specialty producer in the future. We also expect their capital expenditures to increase, as previously mentioned, which will drive their free cash flows downward. So for our quantitative valuation, as previously mentioned, we used a 75% to 25% weighted average of the market multiples and DCF approaches. We wanted to include both methods because we thought that both had their merits in helping to help us predict the future value of PolyOne. We weighted the market multiples method higher because we felt that the quality of PolyOne's comps in the industry were very high, and that they could help us predict the future value of PolyOne in 2021. However, we still wanted to include the discounted cash flows method due to its sound methodology and the fact that we felt that it captured the transformation that PolyOne will be making from a full-on commodity producer to a specialty producer in the future, and the growing pains associated with it. So for our market multiples approach, we decided to use a 50-50 weighted average of the EV to EBITDA and forward PE multiples. We wanted to include both multiples to help us capture both the levered and unlevered value of the firm in 2021. When we picked our comps, we tried to pick companies that were similar to PolyOne in terms of both size and also their products in the market. We tried to include a mix of both commodity and specialty to reflect the fact that they still have a hand in the commodity industry. For our multiples in 2021, we used consensus data from FactSet and averaged these multiples together to come up with the multiples that we would use in our analysis. So for the DCF approach, we decided to use free cash flows of the firm as our cash flow to discount rather than free cash flow to equity. This is because we wanted to help capture the unlevered value of the firm rather than the levered value of the firm in this situation. We use weighted average cost of capital to discount our cash flows, and our terminal growth rate and our terminal value was based on world GDP growth due to the fact that PolyOne is geographically exposed to several different regions worldwide. So the biggest risk that we saw in our analysis was the risk of economic downturn and trade wars in PolyOne's regions that they do business in. They're exposed to several different regions worldwide, as we previously mentioned, including North America and Asia. The trade wars going on between the United States and China right now present a big risk to them, as additionally, any economic downturn in any region would be harmful to them, as this could set off a chain of events that sees the world economy dropping and is harmful to a levered company such as PolyOne, who will be facing multiplied losses on their ROE after they lose on their ROA. We also think that PolyOne's high debt balance presents a further risk in the risk of bankruptcy and refinancing. PolyOne will most likely not go bankrupt in the future, as they seem to have sufficient free cash flow and cash balance to cover the debt that's coming due in 2022. However, if they do decide to refinance this debt, it will kick it further down the road and raise their interest expense for the time being, which would be diluted to their earnings per share. Additionally, bankruptcy is always a risk and would cause an almost complete loss of shareholders, as PolyOne would have to repay its creditors before its shareholders. Management has also cited low supply of factory workers as a big risk in their business, as not being able to fill their factories could see them losing out on revenue and market share. So in summary, we're issuing a hold recommendation on PolyOne Corporation's common stock. This is due to our 2021 target price of $30 per share. We felt in our situation that the downside risks in our analysis, most significantly economic downturn and trade wars, bankruptcy or refinancing risk, and the shortage of labor workers, and numerous others outweigh the upside risks in our analysis. Additionally, if PolyOne is unable to meet the growth expectations that we set forward, we would consider downgrading it to a sell recommendation due to the risk associated with the investment. And now we're open to questions if you guys have any, and we can move on to the appendix.
I have one on that risk analysis chart.
Yeah.
Go back to that. You say the environmental fines are towards the high end, but yet low impact.
Yeah, so.
And then one other thing that I'm thinking may be associated with that is that goodwill impairment. Maybe you can expand on that a little. What do you mean by goodwill impairment? Where will that come from?
So PolyOne has a high balance of goodwill due to the fact that they've had an aggressive M&A strategy over the past few years, and any change in fair value of the assets that they purchase could cause an impairment in their goodwill, and that loss shows up directly to their income statement and would be representative of a direct dilutive loss to shareholders. And the environmental fines. PolyOne's been identified as a potentially responsible party by the EPA, and basically what that means is that the nature of their business